Okay. Well, hi everyone. Thank you for joining us. My name is Nicole Fisher. I'm going to be introducing you to Tony Watson with Robert Hall and Associates, and he'll be going over President Biden's Green Book and how it might be impacting your tax planning. But before I hand it over, I just wanted to introduce myself and Marshall Reddick and explain a little more about what we do and how we're different for those that may not have worked with us before. Let's go to the first slide. Whoops. I'm clicking and it's not, there we go. Okay, so we have three primary services. We're a brokerage. We have a very large presence here in California, but we are in out-of-state markets as well. We do both primary residence and investment properties. But what really sets us apart from other brokerages is we really try to be a one-stop shop for real estate investors. Our second arm is we do private lending, and here we have two sides, two clients. So one client is our borrowers, and those are people looking to do fix and flips or buy a property with a self-directed retirement account. And then we also have lenders, which are investors that actually loan out the mortgages. So if you're interested in being a lender, we can connect you with specific borrowers. Or if you're interested in a more hands-off approach, we also have a mortgage fund that you can invest in and even use a self-directed IRA. And then we also do property management. And this is actually huge. This is what really sets us apart because our property management is in-house, and our whole reason for even having property management is basically to keep our investors happy. Once we find you that investment property, we really stay involved, and we're accountable to you after the home sale and getting you, the right tenant, get it rented for the right amount, and that sort of thing. A lot of money can be lost on an investment property through bad property management. So it's our job to make sure that that does not happen to you. A little bit more about me. My name is Nicole Fisher. I'm a realtor and an investment advisor here at Marshall Reddick. I actually began my relationship with Marshall Reddick as an investor myself. My first career was in finance and accounting. I'm actually a licensed CPA, although I'm inactive now, but I never did taxes, so I cannot answer your tax questions. I will default to Tony on all of those. I went into audit at KPMG after college, and after several years as a corporate auditor for a big public tech giants in Silicon Valley, I went into corporate finance. And throughout my career, though, I was always interested in real estate and investing and flipping. And while I was working in corporate finance, I was lucky enough to discover Marshall Reddick at a meetup. And being in California with sky-high prices and in a career where I was working 80-hour weeks, I didn't really have the time or the resources for real estate investing. And so when I found Marshall Reddick, it was like this aha moment for me, like this is what I had been looking for. So I purchased two properties out of state through Marshall Reddick in 2015. And then after I had my daughters, I have a 5-year-old and a 3-year-old, I was just ready for a career change, and it made sense to me to get my real estate license and come here. And now I'm an investment advisor, just to help people learn how to do basically what I did. So our markets, we're technically in 16 markets. The green boxes are where we actually have physical presence, a brick and mortar office, and we do our own property management. So if you are interested in any of these markets, we can definitely help you with that. And then if you're wondering why these markets, because it seems like everywhere is a hot market right now. But for Marshall Reddick, we really look at 7 different areas, 7 different criteria of what would make a strong market to invest in. Oops, where's number 1? There it is. Job market. We need to have a very continued growth job market environment. Vacancy rate, obviously we want low vacancy rates. Economic diversity, this one's very important. We have lots of different downturns, and the more diverse an area can be, it just really helps the trend in the long run. Housing affordabilities, the numbers have to make sense. Will the mortgage cover the cost? Can you be cash flow positive? Landlord friendly. If you're in California, we are not a landlord friendly state. Not every state is like that, so we look for states that are much more landlord friendly. Strong education, again, going back to that economic diversity, higher education, also military, other things like that, just to to diversify even further. And then, of course, reliable property management. As I already mentioned, you can lose a lot of money with a bad property manager. So having a reliable property management company is extremely important. And what can you expect from a consultation with an advisor? After this call, we'll be reaching out to you. And if you are interested in a consultation with Marshall Reddick, that would be me. I'll be giving you a call. And these are the things that we would go over. We would go over the why, how, when, what, where, and who. You know, setting goals, evaluating your options, talking about time frame and what your criteria are. And I would be helping you identify what markets would be good for you, and then introducing you to all the key players along the way to help you execute on that plan. And so here's my contact information. Again, I'll be reaching out, but if you know you want a consultation, you could definitely reach out to me here. And with that, I will go ahead and pass it over to Tony from Robert Hall for the part of the presentation you've been waiting for, President Biden's Green Book.
Thank you so much, Nicole. Thanks to everyone at Marshall Reddick for having me back. It's always enjoyable to share with like-minded individuals the interesting topics of taxation and tax code changes and all of the above. I'll tell you, it's a very, very interesting time we're all living in. Hopefully everyone is staying safe and staying healthy. The past 2 years have been very, very unique years from a number of perspectives, or a couple of perspectives. But I think the one thing that we've all learned is that the way we get through very dark times as a human race is just to join forces and stick together and try not to lose our sanity, right? Because I can tell you right now that there's a lot of craziness going on in the world, and the one thing that we have control of is our own personal worlds and the way we treat other people and all of the above. So one thing that I've seen coming out of the pandemic is more drive in the self-employed world and self-employed fields than in the past. Kind of looking at the past 17 years that I've worked in my industry and in my career, I've seen more people have drive and coming out of this pandemic just focusing on building legacy, building wealth, making the right financial decisions. And that is really powerful for me as a tax advisor, for me as a small business owner, seeing people not give up. That's incredibly important. Now, on the horizon, we do have a new internal revenue code. This green book that they're calling it is going to be the most significant change or alteration to the internal revenue code, dating back almost 100 years, which is a little exciting, obviously scary, not really knowing what is on the horizon for us as business owners, as real estate investors. But the one thing that we can truly focus on and really put importance on is the power of planning ahead. Right now, we know of several parts of the Green Book that will pass. No internal revenue code has actually been written yet in Scripture, but we have a number of things that we do know for a fact will pass as they have in the past. But like a lot of the important topics, we're still waiting on the small print. The fine verbiage, those little tweaks to the Internal Revenue Code that actually will come as the months pass, meaning that whatever they pass into finalization into legal code will change and will be amended several times, maybe not even several times, maybe many times over the next year to 2 years to see how the economy is impacted by some of these significant changes. It happened in 2018. It happened in 2012 with the Obamacare bill. They amended those bills, so that the CARES Act was amended like 20 some odd times, and that was just over the past 2 years. So we definitely have some time to wrap our heads around some of these major changes, and most importantly, to plan ahead. So I believe that everyone can see my Unpacking President Biden's Green Book. I see it here on my screen. I see that it is sharing, and hopefully you can all hear me. But I look forward to sharing this information with you as we move forward in today's presentation. A little bit about me. My name's Tony Watson, obviously. I introduced myself, and thank you once again, Nicole, for sharing my information and introducing. Like I said, we always enjoy working with like-minded individuals such as Marshall Reddick. and their team. I've been doing taxes for, this will be my 17th tax season this year. I am not only an enrolled agent practicing in the tax preparation world, but I'm also the keynote speaker for our firm. And my clientele list alone, I'd say that my clients currently manage wholesale commission sale roughly about $350 million, north now of $350 million in managed real estate and other business dealings. I myself am also a real estate investor. So aside from public speaking and tax preparation, I also very much practice what I preach. I talk about the power of real estate investing, the benefits of tax sheltering through real estate investments, and obviously buying long-term appreciating assets and how that can help you exponentially grow your wealth over the coming years. So at Robert Hall & Associates, all of our education is free. So we're producing and presenting over 140 plus times each year during the pandemic, even more than that. I think that in 2020, I did close to 170 plus seminars and webinars just to get education out to the general public about the CARES Act and some of the changes under the new pandemic rules, PPP loans, EIDL loans, all of the above. So we do see a lot here at Robert Hall & Associates. More than just real estate, actually, small business, and all the way down to the individual W-2 wage earners and what the benefits are of deducting certain things on their individual tax returns. I am not a one-man operation by any means. We have a wonderful senior accounting staff. I think we are now 52 employees strong here at Robert Hall. We had a little bit of ebb and flow during the pandemic. Naturally, as most industries did, some of our accountants moved out of the industry, moved to other states. But now we are fully staffed, back up and fully operational for the 2021 filing season, which we are kind of approaching the middle of this tax season. I know that 2022 is going to be a very unique year from a financial perspective with this new code on the horizon. But our goal as tax professionals, as tax advisors, is to learn that information as quickly and efficiently as possible so we can provide our clients with the most up-to-date information that is available to us. And we file taxes in all 50 states. So I know that working, like I said, with Marshall Reddick and their team, they have investments all over the US. And so if you have rental investments or businesses elsewhere in the US, but your primary residence or resident state is, let's say, California, we can assist not only with the California filing, but we can also assist with all of the other state filings as well. One very unique thing about our firm is that we do have an internal audit department. So heaven forbid our work is questioned, we do not send our clients to represent themselves in front of the IRS. We actually go to the IRS and represent our clients. That's something that gives our clients peace of mind that they're in good hands. And naturally, with the IRS in a complete disarray at the moment, 24 million documents behind in processing, a lot of delays on actually both the government and the state levels due to the pandemic and the unforeseen future of the Internal Revenue Code and those changes. We are seeing many delays at all levels of revenue agency, both federal and state. So this year is very much the year, and as the past 2 years have been, is very much the year of patience, not only for tax advisors with the IRS and the state agencies, but also with the taxpayer. What used to be a simple call to the IRS, maybe an hour hold time, has now turned into being hung up on by the IRS. We call in, we wait on the phone for 2 or 3 hours, and then the agents never pick up and our phone call gets disconnected. The processing times for correspondence taking months, amended return refunds taking 8 to 10 months, not ordinary refunds, but amendments to returns and refunds coming back from that, taking 8 to 10 months to process. So very much I've had to adopt or revisit the internal part of my body, which holds the level of patience that I have with the government agencies. So just to kind of let you know about where we are at as an economy here in the US, with being on the brink of full-blown war with other parts of the world, there is just a lot going on. And so make sure that you keep your your motion moving forward and control that patience, because it does take time to get things processed nowadays, unlike in past years where it might have been a simple call to a local agent, so on and so forth. As a firm, we've been around for 50 years. We service around 10,000 tax filings. Great reviews online. You can check us out at roberthalltaxes.com. Won a number of awards and in fact, Glendale's best accounting firm a couple of years in a row. And then we are also, as a firm, assisting clients with over $1 billion in real estate operations management and wholesaling and other business dealings, obviously. But we feel very proud to be able to assist that many clients all across the US and globally. We do also assist with foreign bank account and foreign asset reporting here in the US. We are not just a tax preparation firm. We also offer incorporating services, like I mentioned, internal auditing, financial planning, bookkeeping services, payroll. I mean, we're kind of a one-stop shop for all of your financial needs. So even if you don't need tax preparation services, we have a Rolodex. I'll age myself right now. We have a Rolodex. Some of you might not know what Rolodexes are, but we have a Rolodex of vendors that is probably second to none. We've been in the industry long enough to really build and vet out many referral sources. And we truly believe that they all offer stellar services and products for our clients, which that vendor list includes Marshall Reddick. So we would not be in business with people who we didn't know that they knew what they were doing. So we appreciate everybody being a part of our team and a part of Marshall Reddick's team. And we, like I mentioned, always enjoy working with like-minded individuals. Before I jump right into everything, I did want to mention, and I'll mention this at the end, we do offer free consultations. So keep that in mind as we go throughout today's presentation. I'll show you that information at the tail end of today. So some of the highlights coming out of this green book, things that are really going to impact a majority of Americans in a little bit of a higher income bracket. And remember that this is not only the W-2 wage earners making above these two thresholds. This could be an individual disposing of a rental investment, seeing or yielding a high gain from that sale of property, and possibly bumping maybe a teacher or two teachers or a firefighter into an income bracket where they pay similar income tax rates as Jeff Bezos and Elon Musk and all of the billionaires of the world. It doesn't take that much to have that one unique year that bumps you up above one of these income bracket thresholds. So we are going to see a change to the highest income bracket, up from 37% as it is today, all the way up to 39.6% if you are married filing joint and making over $509,300, or if you are single or head of household making over $452,700. Now, from 37 to 39.6, a 2.6% increase might not seem like a lot, but 2.6% on $500,000 is a lot of tax. And a lot of other things change when you get into those higher income brackets, on top of the 39.6% on any capital gain that you receive, on any recaptured depreciation or any other syndication or what's called non-passive or passive business related income. On top of the 39.6%, you have 3.8% of net investment tax, which is something that started back, I believe, prior to 2018's tax reform bill, which is the wealthy contributing to free healthcare here in the United States of America. So 39.6% plus 3.8%, that's kind of all in on the federal side. And then you've got the wonderful state income tax wherever you live and invest. California is a very unique state. So if you are a California investor, you pay tax on your worldwide income. And so that could be upwards of, in this bracket, it could be upwards of 10.3+%. So you add this all up, you're paying well over 50% of your income in federal and state income tax. Now, before you start, throwing your computer monitors out the window or kicking your computer or pouring coffee on the keyboard with such anger and frustration about this, understand that this could be avoided simply by putting a plan in place. We've all heard the famous saying, failing to plan is ultimately planning to fail. And that phrase goes hand in hand with what I do, with what my senior associates do here at the firm, more than any other phrase, I'd say. Failing to plan is ultimately planning to fail. If you do not plan ahead prior to the end of your calendar year, guess what? You're not going to like the end result. You are going to walk into your tax advisor's office. They're going to dial in the numbers. They're going to help you out to the best of their ability while not breaking the rules, right? Because tax evasion is illegal. We all know that. But guess what is not illegal? Tax avoidance. So always remember that tax evasion is illegal. Proper tax avoidance is not. So putting a plan in place will allow you to avoid overpaying in tax and not evade paying tax, simply by having a plan in place before the end of the year and achieving the results of an obligation in tax to be paid and not a penny more than that obligated amount. I am just as frustrated as you staring at this screen thinking, wow, if I liquidate an asset or if I have a killer year in my industry and I've been working my tail off, I have not stopped preparing taxes throughout the last 2 years. I didn't take and I took a week off after last tax season to be with my family and my newborn daughter. But at the end of the day, we worked our butts off throughout the last 2 years, making sure that we had enough information for our clients to really empower them to achieve these results. Just like all of you in your respective industries, we continued to work as much as we could. And we should pat ourselves on the back. When a lot of industries were closing down, people felt like they were out of luck and they were out of jobs and they were collecting unemployment. There was a lot of fear in the world. And so something like this should not be fearful in your mind. It should be a goal for you to achieve. Because I can tell you right now that your problems in this income bracket are going to be much different problems than individuals who are collecting unemployment and living off of government and state subsidy benefits. So the problems change. Nonetheless, they are problems, but I would much rather have problems in this income bracket than the latter. But once again, you have to put a plan in place to retain most of this wealth rather than overspending with the federal government and the state agencies. Another major change on the horizon is the increase to the corporate tax rate. We currently have a C corporation tax rate, a large corporation tax rate. Normally, C corporations are large entities with over 100 shareholders, or maybe specific syndications that have foreign income investors. So some of you may actually be filing as C corporations. And right now, currently, over the past couple of years, we've been enjoying a very low C corporation tax rate of 21%. Prior to 2018, the C corporation tax rate was 35%. So we saw a nice decrease in overall bottom line percentage liability. But under the Biden Green Book, we are going to see a 7% bump, not back up to 35%, thank goodness, but we are going to see a 7% bump from 21 to 28%. I am 99% positive that this will change and this will go into effect. As of today, it has not, but I do believe that this will be final in the Internal Revenue Code once the bill does pass, or once the final Internal Revenue Code is changed. So keep aware of that. Now, if you're an S corporation or an LLC, you enjoy the pass-through benefits of those entities, not the higher double taxation rate of 21 or 28%. S corps and LLCs are considered to be pass-through entities, so they really pay nothing in federal income tax at the corporation or entity level. It passes through all of the liability to you individually on your personal tax return, and you pay income tax on the personal 1040 return to the federal government. California and other states will have their miscellaneous filing fees, but at the end of the day, a majority of the liability will pass through to you personally. Now, one thing that the next two slides I'm going to spend a little bit more time on, because this impacts real estate investors more than the other parts that are potentially changing under the Internal Revenue Code. One major change under Biden's Green Book would be a change to the long-term capital gain and qualified dividend rate. Right now, currently as it stands, if we sell a capital asset like a property for a long-term capital gain, we are either subject currently to either a 15% federal long-term capital gain rate or 20% long-term capital gain rate, depending on where our income lands. The long-term capital gain rate at 20% is normally for individuals making north of roughly $400,000 in taxable income, taxable income. If you're under 400,000, roughly 400,000 in taxable income, you are subject to the 15% long-term capital gain rate. That's out as the code stands currently. With this potential change on the horizon, and I do believe that this will be final under Biden's Green Book, or once this new tax code passes, if your capital gain, so let's say you sell a property and the capital gain alone bumps you individually or married filing joint income above $500,000 if you're single, or above $1 million if you're married filing joint, every dollar above and beyond one of these two thresholds, if it is capital gain that bumps you above these two thresholds, every dollar above these two thresholds would not be subject to 15 or 20% long-term capital gain rate. It would be subject to 39.6% long-term capital gain tax. 39.6%, don't know where the 0.6% came from, round up, it's 40%. Then on top of that, you have the 3.8% net investment tax, so you're roughly at 43.8%. for 43.4% if you're taking off the, or I'm sorry, 43.2% if you're taking off that 0.6% overage. But you get what I'm trying to point out here is that you're going to be paying just in federal long-term capital gain tax well above 40%, and that doesn't even include the 9.3 to 10% on the state side. So add that all up, you're paying over 50% long-term capital gain tax on every dollar above $500,000 for single individuals, $1 million for married filing joint. So naturally, you think, wow, I don't want to sell my properties. I don't want to sell stock positions for long-term benefit. Are there other options for me to shelter that income? So we'll talk about that in the next slide. But I do want to give you an example. Married filing joint at the bottom here, married filing joint who has total taxable income of $1.2 million, right? But out of that $1.2 million, let's say that $400,000 is capital gain. So 400 grand added on to 800,000 puts you at 1.2 million. So you're technically $200,000 above the $1 million threshold. That $200,000 overage would not be subject to the 15 or 20% long-term capital gain rate. That 200 grand would be subject to 39.6% plus 3.8% plus 9.3%. So you're paying over $100,000 in long-term capital gain tax just on the $200,000 overage amount. So naturally you're thinking, wow, well, I don't ever want to sell anything. I want to make sure that I retain most of this wealth. Is there a way for me to cycle that money back into other investments? How do I approach that? How do I keep my gains overall less and keep myself below one of these two thresholds? Well, number one, like I mentioned earlier, you have to sit down with your accountant prior to December 31st. Because what happens on December 31st at midnight, right? The year ends. We celebrate the new year and we pass on into the following calendar year. So there's very little, we could max out a deferred comp retirement plan or maybe max out an HSA, but there are only a few options in the next year that you can do for the previous year's tax filing. This particular gain that you are seeing is a realized gain in the calendar year. So naturally, any sheltering benefit that you get or any strategy that you're trying to implement also has to be implemented in that same calendar year prior to December 31st to help you offset this long-term capital gain tax or any other income that you had generated throughout the year. So a lot of investors are fearing this potential change. And I can tell you right now that the federal government right now is really focused on taxing wealthy investors more so than ever before. They want to make sure that if your income overall is above $400,000, maybe $500,000, that they hit you with the tax bill to cover a majority of the debt that they've put themselves in, the government has put themselves in over the last 2 years. This is a main focus and main concern to the federal government moving into the 2022 calendar year and also looking forward into 2024 and however long this potential tax code change sticks around for. So just be aware that these potential changes are on the horizon. Now, if you sell a property and you're a real estate investor that's been around for a while, you've been in the real estate game for a long time, you understand Section 1031 of the Internal Revenue Code, which allows you to not sell property for a gain, but to take that gain and defer it or cycle it into another like-kind investment. You can't do this with your primary residence or maybe a second personal residence, but if it's a rental investment, commercial, residential, multi-unit, doesn't matter what it is, as long as it's a rental investment, under Section 1031 of the Internal Revenue Code, you can take this gain and cycle it into another investment property of equal or greater value and fully defer the capital gain tax on the full gain. Because you're not taking the gain, you're actually cycling it into another like-kind investment. So Section 1031 has been around for over 100 years. So like I had mentioned earlier in the presentation, some of these changes on the horizon are changing parts of the Internal Revenue Code that have been around for a century or more. So understand that this will be the most significant change to the Internal Revenue Code dating back probably 100 years because it's changing parts of the code that have been around for a very long time. So for you real estate investors like myself, who never plan on selling property and only exchanging till the end of time, kicking that tax can down the road until you kick the can, right? Because that's in theory what you're doing with a 1031 exchange. You're kicking that liability down the road until you die and you leave the benefit, the stepped up basis benefit and the inheritance benefit for your next of kin or your surviving spouse, where they get all of the tax benefits. So you're not really receiving any of the tax benefit while you're living. That unfortunate life event has to happen in death where all of your beneficiaries and your surviving spouse receive all of the tax benefit on these assets. But until that time, you are doing 1031 exchanges to avoid this particular capital gain tax. And you're thinking, okay, well, I'll never be subject to this because I'll just continue to 1031 exchange my properties. Well, one thing that's also on the docket to change is Section 1031 of the Internal Revenue Code, which currently allows you to defer all gain with no limits to the gain amount. The gain there is no cap to the gain in deferral, which allows you to defer all of that capital gain into another like-kind investment. That's how the code stands now. But the federal government, and I've heard some whispers in my industry about the federal government tabling this discussion, but right now, because it's not set in stone, it's not written in Internal Revenue Code, my head is on a swivel because I've known something since day one of being a real estate investor, of being a business owner myself, that it doesn't exist unless it's in writing, right? We as business owners, as real estate investors, we understand the concept of, hey, if the keys aren't in my hand, I don't own the property, right? Until those keys are in my hand and I can use those keys to open that front door, I technically don't own the property, right? So similar situation with the Internal Revenue Code. If it's not written in stone with the IRC, the Internal Revenue Code, it still doesn't exist yet, right? So even though the federal government and some whispers in the accounting industry state that this discussion has been tabled for the time being, I still believe that this potentially could change. Now, the thresholds might change. They might detail out some specifics in Section 1031 to allow individuals to take it, other individuals not to be allowed the deferral of gain, but we'll have to wait and see what the final code comes out with. I do know, before I get into detail about how this works, I do know a couple statistics, very unique statistics regarding the 1031 exchange industry. Number one, the exchange industry makes up for about 16% of all United States real estate transactions on a yearly basis. 16%. You might not think that's a whole lot, but if you think about all of the real estate transactions in the US, all of the closing costs and the rehab costs and the construction costs and the lender fees, all of these jobs that are created every time a property sells, is acquired, is exchanged, is refied. Think about how many jobs that creates for the United States economy. So if you take all of those real estate transactions and you take 16% of those real estate transactions, that number, that is the exchange industry. So naturally, if the government decides to limit the amount of gain to be able to defer gain in an exchange, if they start to limit that dollar amount, guess what? Less people are going to elect the 1031 exchange election. Less people are going to be selling properties because if I sell my property outright and I pay that large capital gain like we talked about in the previous slide, well, I'm not going to sell it. And if my ability to exchange is being limited, I'm not going to sell my property at all. I'm just going to sit on it, wait till I die, and then my children get the benefit here. So naturally, this could impact the real estate industry from an investment vehicle perspective significantly if they decide to limit the gain of deferral, the deferral amount to $500,000 per taxpayer. Meaning if you are single and not married, you are allowed a $500,000 deferral in a 1031 exchange. Every dollar above and beyond that in capital gain would be subject to the new rules, potentially at 39.6% federal and 9.3 to 10% state. For a married filing joint couple, you get double this exclusion because it's $500,000 per taxpayer. So $1 million can be deferred in capital gain in a like-kind exchange. Once again, if you're married filing joint. Naturally, as California investors, as New York investors, as Texas investors, and as Hawaii resident investors, we tend to see gains at this level, right? In California, I have a client who just sold a property in Burbank. Their basis or original purchase price was in the $350,000 to $400,000 range about 25, 30 years ago. Now they're looking to sell it for close to $2 million. It's a rental property, not a primary residence. It's a rental property, and they are looking into doing a 1031 tax deferred exchange, which is great for them because they get to take this one single family home valued at roughly $2 million and exchange it for 10 units, 15 units, 20 units elsewhere in the US because the California dollar goes a lot further elsewhere in the US. As the code stands now, they can take that full, $1.5, $1.6 million gain after closing costs and depreciation, recapture, all of the above. They're able to take that and buy multiple units elsewhere in the US, diversifying their real estate portfolio investments. And instead of having one revenue stream, now they have 15 revenue streams, right? So that in theory is what a lot of California investors do with their properties through exchanges. But if this particular part of the code changes and that individual can only exchange, let's say $500,000 or $1 million, and let's just say that their individual income outside of real estate is, I don't know, $250,000, right? So if they have $250,000 plus $500,000 roughly in overage in capital gain, all of a sudden, if that's a single taxpayer, they're paying a heck of a lot of money in capital gain tax, close to over 50% of their capital gain on every dollar above a $500,000 threshold. For a married filing joint couple, that gain would be okay because it's still under $1 million, right? But at the end of the day, if they're looking, I'm sorry, if they're married filing joint, they can only defer $1 million of capital gain, which they're looking at what, 1.5 million. So they're looking at tax on about $500,000 in capital gain. These numbers don't have to make sense to you. Just understand that if the gain overall puts you above one of these two thresholds, all of a sudden you do not receive the full tax deferred benefit of the section 1031 through the 1031 tax deferred exchange. I personally believe, professionally, I have to say, I have to wait until it's actually set in stone to believe in it, but this is on the bill and is supposed to be passed. Personally, I don't believe that this is going to pass. Personally, I do believe that if it does pass, that the thresholds will be much higher. Because once again, we do know a couple stats about how it makes up for 16% of the United States real estate market and all of the real estate sales here in the US. But the other two statistics that are very interesting is, number one, it makes up for 16%. Number two, it provides the US economy and the global economy with over 600,000 jobs, meaning that the 1031 exchange industry has over 600,000 employees globally, right? So that's a good chunk of employment here in the US and abroad, where the government is collecting Social Security tax on those wages, Medicare tax on those wages, state disability insurance on those payments, employment training tax, and also federal and state income tax on whatever gains those employees are making within the 1031 exchange industry. Number two. So number three, the federal government generates over $40 billion in taxable earnings, actual revenue, through 1031 exchanges and all of the employment that is created by this industry. So why would the federal government cut off their nose to spite their face? Well, why does the government do anything that we question these days? Their rhyme for reason is completely skewed, and in a lot of cases we don't see things the same way that they do, the federal government. But at the end of the day, they are the ones coming up with these rules. Not so much just the Biden administration or the Trump administration or the Obama administration. They all put together plans, but at the end of the day, when all of those bills are passed and it gets sent over to the Internal Revenue Service for changing and alteration, a lot of that will change, because when they implement these strategies and promote these changes, they don't truly understand the taper off impact that the United States economy will see or be affected by. So we will see changes to the Internal Revenue Code, even if we get a final bill in our hands, let's say in the next week or so. That bill will be changed and altered at least 10, 15 times before the end of this calendar year, I guarantee it. And so 2-3 years from now, could they repeal all of these changes to the Internal Revenue Code? Yes, anything can technically happen. Look what happened in 2020. We were hit with a pandemic, and now in 2022, we're getting involved in a war between Russia and Ukraine. It's anything can happen. So our heads have to be on a swivel, so to speak, and we also need to plan ahead. As soon as this particular change is noted in the Internal Revenue Code, people will probably not have very much time to plan ahead for this. So you need to start putting a plan in place now in case this particular change does go into effect. All right. Power of planning right there. Plan ahead to ultimately not plan to fail, right? Failing to plan is ultimately planning to fail. So keep all of that in mind. Now, a lot of us as taxpayers, as individual business owners, as real estate investors, we've been hearing on the news and in newspapers and trade journals and from our tax professionals and maybe your neighbor, your local your neighborhood professional accountant, maybe talking to you over a drink or hanging out outside watching your kids play. We've all heard that $400,000 of taxable income is the threshold that once you pass and go above and beyond 400 grand, that the tax code will significantly change for you. And this is absolutely true. At 400 grand or greater in taxable income, the old code even changes bottom line liability for you because you start to become taxed as a high net wealth earner or taxpayer. So naturally, as you start to make more than 400 grand, the federal government is going to hit you with a lot of limitations on capital gain taxes, more net investment tax, less credits that you qualify for. So the tax rates significantly increase at above 400 grand. The current administration, the Biden administration, has really made a point to tell people that, hey, this is kind of the income limit that once you pass, we are going to be taxing these individuals at a much higher rate. So once again, what's our goal as taxpayers before the end of the year is to figure out creative ways to shelter our income and potentially drop ourselves below $400,000 in overall taxable income. Now, like I mentioned earlier, the problems change for you once you breach this income threshold, but a lot of those problems are actually good problems because you're taking home a lot of money at the end of the day. If you are north of $1 million, $2 million, $3 million, you'll just end up paying essentially a flat tax because nothing really changes once you breach that $509,000 to $600,000 threshold. You'll want to focus more of your time and energy on real estate investments or sheltered investments that allow you to dollar for dollar reduce your income. But remember that even if you're at $1 million, $2 million, $300 in revenue, every dollar that you can shelter is saving you roughly 50 cents on the dollar, maybe even more in tax. So at that level of income, you are definitely a qualified borrower. You have the ability to maneuver in and out of what are called qualified investor investments, where you are maybe liquid more than $1 million in overall assets. So other doors and opportunities open up to you because you can navigate and move in and out of investments freely because you have the cash to do so. So the games do change for the wealthy, and that's a majority of why the United States general public hates the wealthy, and we hate executives and we hate these billionaires of the world because they make all this money, pay very little tax. Well, I can tell you right now that they do end up paying tax. It just might not be seen by the general public. As an accountant, I know how C corporations work. I know how dividend taxes work. I know how guaranteed payment tax payments work. I know how alternative minimum tax works. So even though a CEO or an executive might take a zero salary or maybe a $1 W-2, understand it's not because they are not paying any tax that's why this occurs. It's because they have other entities paying the tax on their behalf. Like for instance, when Mark Zuckerberg took a $1 W-2, I don't recall what year this was, but it's because he chose not to take the salary from his corporation, and the corporation inherited his tax on his behalf, which any business can really do for any taxpayer. You don't need to be a billionaire to maximize that part of the Internal Revenue Code. You absolutely want to make sure that you're hitting strides at certain income levels in order to incorporate yourself, because it would be pointless for you to incorporate yourself if your net profit was, 10, 15, 20,000 bucks. You're paying all of these filing fees, really not for any tax benefit because you're already in a low income bracket. But individually speaking, if you are in a higher income bracket and you have the ability to shelter income through incorporated entities, you can play the same game that the Mark Zuckerbergs, the Elon Musks, the Jeff Bezoses of the world play. But in some instances, it doesn't make sense. So before you leave this webinar and go out into the real world and go back to your lives and you say, maybe I should incorporate that. Crazy tax guy, Tony Watson, told me that I could save a lot of money by doing this. Just understand that incorporating is not right for everyone. You may qualify for these benefits, but you absolutely want to take the advice of a tax professional as well as a business attorney to see what kind of legal benefit you get on the incorporating side. Take the advice from us, the professionals, before just jumping into an LLC, an S Corp, or a C corporation entity. Incorporating is not right for everyone, but if you are north of one of these income thresholds, specifically and mainly 400 grand, and you have self-employed income or you have rental cash flow, there may be some creative options for you to start sheltering more of your income. Incorporating is not right for everyone, but for the people who incorporating is right for, it can end up saving you tens of thousands of dollars in tax potentially, and also potentially dropping you below one of these income thresholds and paying a much lower overall tax rate and not being subject to some of these new restrictions that are on the horizon, new limitations and restrictions on the horizon. Additional proposals would be expanding broker reporting for crypto assets. We're already starting to see a lot of that. Extend statute of limitations for listed transactions, make a narrow but favorable change to partnership audit rules, and address the approval process within the IRS for imposing penalties on a taxpayer. Now, coming out of the pandemic, this all seems pretty unfair because we have a lot of rebuilding to do. Whether you saw hardship in your industry or in your family financial situation, personal financial situation, it doesn't mean that the rest of the world wasn't hurting. We are very much at the tail end possibly of the mask mandates and the vaccine mandates and all of these things that we've been kind of hearing over the past 2 years, but we by no means are at the end of the financial perspective or the financial position of the pandemic. We have a very long road to rebuild. There was a lot of money printed in 2020 and 2021, and even though the federal government talked about the US taxpayer not having to pay this money back and that we wouldn't be impacted by it, sure, we don't have to pay it back right now. On our tax returns, we report what we received from the pandemic stimulus checks, and we don't have to pay tax on it. That's what they were meaning, that the US taxpayer would not have to pay tax on that money. And we've seen a lot of relief there. But it's simple economics, folks, that when the federal government turns on the printing machine and then they turn it off and it does nothing to increase the value of the US dollar, someone will have to pay it back. And guess what? It's not going to be the federal government just printing enough money to make up for the rest of the money they printed, because that's not how currency works. That's not how the US economy works. So understand that we are going to see significant tax rate changes over the next 2 to 3 years, unless something happens where the federal government comes up with a creative way to not tax middle income households, which they are not the majority of the US population. The lower income households are the majority of the US population, but there are going to be tax credits for those individuals and tax hikes for middle income as well as higher income earners here in the United States. Whether or not it's going to be spread apart, all of those three brackets evenly or fairly, unfortunately, that's never been the case, and I don't foresee personally and professionally that it will be fair. But at the end of the day, we do have to also understand that as a single business owner, let's say you're a realtor or you are a real estate investor owning rental properties, you may be creating a couple jobs here and there for the US economy, hiring handymen and maybe 1099ing them, but when you pay them cash, that's not really considered to be a job from an internal revenue service perspective, right? Because they're not taxing cash payments, people who are being paid under the table. So we're talking about really the only individuals that get paid via W-2 or 1099. Yes, that is creating jobs, but it's nothing compared to what corporate America, like Amazon and Google and eBay and Tesla and Space, all of these billion-dollar corporations that have been at the forefront of the media outlets over the past 2 years. And not to leave out the medical industries, the people who are creating the rapid tests, so on and so forth. Those businesses create hundreds and hundreds of thousands of jobs for the United States economy. So naturally, the tax code is built to benefit them more than the small business owner. But I'm not saying that you don't get any benefit. You just have to know how to utilize those benefits. And that's where the tax professional advice comes into play. A lot of people think that incorporating is not right for them, that they just have to pay whatever the tax liability is on their cash flow, and that is it at the end of the day. Understand that corporate tax code can very much be implemented the same way for you as a small business owner if the numbers make sense. We do have to make sure that, number one, you're getting great asset protection under an entity structure. Number two, that your revenue is high enough to warrant incorporating. And number three, that the tax savings that you are receiving by incorporating is greater than what it's costing you on a year-to-year basis. We have to make sure that financially it makes sense for you. But once again, you might not think it's right for you, but heed the advice. Take the advice of a tax professional when they suggest for you to take that next step to incorporate or restructure your financial situation. But 400 grand, kind of getting back to the topic at hand, 400 grand or above, these are the individuals that are going to be impacted the most across the board. Other things that are going to change, I'm going to leave this up here kind of as we're wrapping up here. We want to make sure that the clients are getting the answers they need, right? Because sometimes when you ask your preparer, they might not have the answer. They might be on their way out of, into retirement. They haven't studied the changes under the old and potential changes to the new Internal Revenue Code. We here at Robert Hall & Associates are very much not only an educational firm where we promote education to our taxpayers, not teaching them everything that we know, but everything that they should technically know as a business owner, and then leaving the rest up to us. But on top of that education, we just want to make sure that you understand your rights as a United States taxpayer. And that's why we offer these free consultations. Number one, that's why we offer free webinars and continued education platforms for the general public, whether you're a client or not. So if anything, if you don't want a free review of your past 2 years tax returns, at least sign up for the free consultation to be put on our email update list. This will let you know about free upcoming webinars, educational webinars. It'll let you know about potential tax code changes. We'll send out our monthly little magazine article telling you about some updates with our firm and things that have changed as kind of in real time, actually. And as soon as this green book, this Biden tax code change is set in stone, I'm going to need a couple days to educate myself on it, but we will be right back with Marshall Reddick's group and all of the other platforms that we do webinars on to give you all of that updated information and potentially what has set in stone for 2022. I don't foresee very many things being prorated back to January 1st. So I don't foresee us being impacted for last year as much as in 2022. But I do understand that the federal government has the ability to pass the code now and prorate it back to January 1st of 2022. So it will leave us no time to plan for those changes. But once the plans are in place, once the changes are set in stone, we can find what you call loopholes, we call interpretation of the Internal Revenue Code. So it's the same thing. We can find creative ways to utilize this new code to our benefit. We'll need a couple days to kind of wrap our heads around the potential changes or the final changes, but we will be back with updated webinars and seminars as soon as we have that information in our hands. So like I mentioned, we've been doing business with Marshall Reddick and Vince and Tomic and all of the guys, Ross and all the guys at Marshall Reddick for a very, very long guys and gals, I'm sorry, at Marshall Reddick for a very long time. We love working with them. Our clients love working with them. I can't speak more highly than enough than what I'm trying to relay right now. They are like-minded individuals. They understand the wealth growth model in real estate. They understand the ability to diversify investments both inside the state of California and outside the state of California. And they have very unique opportunities to plug their clients into to help shelter money and grow wealth. And so that's the language that we speak here at Robert Hall & Associates. Most of our senior consultants are real estate investors. We've not only seen 1031 exchanges on tax returns, we've not only seen syndications on tax returns, but most of our senior consultants have done that themselves with their own individual tax filings. So you are very much getting not only the education behind these positions, but you're also getting a professional who is very much practicing personally what they are preaching and implementing on your returns. I find that to be very unique about our firm, and I'm very, very honored to be here on behalf of Robert Hall & Associates with a 50-year legacy. Like I mentioned, great reviews online. Naturally, we all, I think, in our industry, we see a couple hiccups here and there between 2020 and 2021. There's a lot of frustration in the air, a lot of impatience in people's lives because they're working from home and their kids are running in and out of their office space while they're on Zoom meetings and everything. Hey, that's the world we're living in. We have to allow for some flexibility because guess what? I am not going through the pandemic alone. You are not going through the pandemic alone. We are going through this together, and we have to support each other, and we have to keep our forward motion, moving forward and making sure that we are making the right decisions for ourselves, for our families, for our communities, and making sure that we don't lose out on some very unique opportunities. And once again, that's why I love working with Marshall Reddick and the team over there, because we are all like-minded individuals with the number one goal of forward progress. And what I tell my clients, and this is what I'll say before I sign off here, is that you might consider what we do saving you tax. So in your mind, you're thinking, well, I go to a tax professional because they are going to save me tax. I want you to reprogram your train of thought. I don't want you to think of it as tax savings anymore. I want you to think of it as wealth retention, because I can get on board quicker with somebody talking to me about growing my wealth than somebody telling me that they're going to save me a couple bucks by giving me a discount on something. I don't really care about the discount. I will pay a service fee for a person who is going to help me grow my wealth. And that is what separates Robert Hall & Associates apart from all of our competitors. Is we may not be the individuals who you stop and want to have a conversation to on the sidewalk because we're all busy in our own individual ways. But when it comes to doing business, you want to work with like-minded professionals, people who are willing to take the time to help you understand why the tax world will help you grow wealth. and more importantly, help you retain that wealth that you've grown for yourself over the past 365 days, 2 years, 5 years, 10 years, 2 decades, right? It is not tax savings, it is wealth retention. So I will leave you with that. Hopefully that is left as food for thought, and that you understand what I'm trying to convey. And I know the tax code is a foreign language for a lot of people. It's hieroglyphics to most of the general public, but it does not have to be. If you have the right people in your court, playing on your court, I think that the success and the win will be inevitable. It'll just be the result of all of your hard work, your focus on planning ahead and achieving that goal and paying your obligation in tax and not a penny more than that obligated amount. So once again, text Robert Hall to the number 72,000. Check us out online, roberthalltaxes.com, or take your smartphone device, open up your camera and scan that QR code at the bottom right part of the screen and get in contact with our office. We still have several openings with some of our senior consultants here for the 2021 filing season. If you're an extension filer, we have plenty of openings during the off season. And if you're not wanting or willing to switch your accountant this year, we're not going anywhere. Like I said, we've been around for 50 years. We have a similar legacy to Marshall Reddick, and I remember meeting Marshall personally years ago. I mean, gosh, it's got to be over a decade ago, maybe 13, 14, 15 years ago. And when I sat down at lunch with him as a young professional with this veteran real estate investor, I felt like he was definitely out of my league, and he was at the time. But at the end of the day, I think that once we had that lunch conversation, we figured that we were very like-minded in many ways. And that was the beginning and the growth of our business relationship. And we've really enjoyed our relationship with Marshall Reddick over the years. So take care, everyone. Stay safe, stay healthy, and we look forward to hearing from you in the near future. And as always, plan ahead and plan ahead so that you ultimately plan to win. Thanks again. Take care.
Thank you, Tony. That was a lot of information and very good information. We always appreciate you breaking things down for us, and we also appreciate our relationship with you and Robert Hall and Associates as well.
Thank you.
So thank you again. We aren't going to be doing any live Q&A, but if any of you attendees have asked any questions or if you have any additional questions, I will be following up to make sure that we get all those answered. And so, yeah. Thank you so much, Tony, and everyone. Have a good evening.
Absolutely. Take care.
Bye.